Buying a protective put is the purest way to short the market, but switching to a spread can reduce your daily time decay cost by over 40%. When you expect a stock to drop, the long put and the bear put spread are the two most common tools in your arsenal. The long put offers unlimited profit potential if the stock goes to zero, essentially acting as pure insurance. However, that unlimited potential comes with a massive price tag in the form of premium. The bear put spread, also known as a vertical spread, modifies the trade by selling a cheaper option against the one you buy. This simple addition drastically alters your probability of profit and your return on investment. We need to decide, are you paying for precision or are you paying for panic? Let's look at the mechanics. A long put is straightforward. You buy a put option at a specific strike price. Your break-even is the strike price minus the premium paid. You need the stock to move significantly just to cover the cost of entry. A bear put spread involves buying that same strike, but simultaneously selling a lower strike put. The premium you collect from selling the lower put offsets the cost of the one you bought. This lowers the net debit, which moves your break-even point closer to the current stock price. This cost reduction is the primary advantage of the spread. By reducing your capital outlay, you increase your percentage return on investment if the stock makes a moderate move. You risk less to enter the trade, which helps preserve your portfolio if your bearish thesis turns out to be wrong. However, there is no free lunch in the options market. The trade-off for a cheaper entry is a capped profit potential. If the stock crashes well below your short strike, you stop making money, whereas the long put would keep gaining value as the stock falls. This brings us to the first critical decision factor, convexity. Convexity is the ability of a trade to gain value exponentially during extreme events. The long put is convex, the spread is not. If you are hedging against a black swan event, the spread's cap makes it a poor insurance policy. But most market moves aren't black swans. They are standard corrections. In a standard correction, the Greeks, specifically Theta and Vega, become your biggest enemies when holding a long put. Let's start with Theta, or time decay. Every day you hold a long put, it loses value due to time decay. This is negative Theta. With a bear put spread, you are selling an option, which has positive Theta. The short options decay helps offset the long options decay, slowing down the bleeding. This makes the spread much more forgiving. If the market stays flat or drifts down slowly, the long put might still lose money because time decay eats up the small profits. The spread, having a lower cost basis and lower Theta, can be profitable even in a slow grind lower. Next, we must consider implied volatility, or IV. When markets drop, IV usually spikes. A long put benefits massively from this Vega expansion. The value of the option balloons not just because of price, but because fear enters the market. The bear put spread is different. Because you are short one leg and long another, you are Vega neutral or close to it. If volatility spikes, your long leg gains value, but your short leg loses value, becomes more expensive to buy back, canceling out the volatility benefit. This creates a clear dichotomy. The long put is a volatility play as much as a directional one. You want chaos. The bear put spread is a pure directional play. You just want the price to go from A to B, regardless of how much panic is in the market. So how do you choose? It comes down to your target. If you are targeting a specific support level, say, a move from $100 to $90, the spread is mathematically superior. You don't need the gains below $90, so why pay for them? However, if you are hedging a portfolio, the long put is generally preferred despite the cost. A hedge needs to work hardest when the market breaks through support levels. In a 20% market crash, a spread caps out early, leaving you exposed to the remaining losses. Conversely, for speculation or swing trading, the spread is usually the winner. Speculators often have tight stop losses and clear profit targets. The spread offers a higher probability of profit and suffers less from the IV crush that happens when fear subsides. Let's synthesize this into a decision flowchart. Ask yourself, is this a crash protection trade? If yes, buy the long put. If no, ask, do I have a specific price target? If yes, sell the put at that target to create a spread. Also consider the environment. In low volatility environments, long puts are cheap to buy. In high volatility environments, premiums are expensive, making the spread more attractive because selling the other leg helps finance that expensive premium. A common mistake beginners make is buying the long put, seeing the stock drop, but still losing money because implied volatility collapsed after an event like earnings. This is called vol crush. The spread protects you from this scenario. Remember, the spread is a defined risk, defined reward trade. You know exactly what you can make and exactly what you can lose. The long put is defined risk, but undefined reward. You are paying extra for the lottery ticket possibility of a massive crash. To summarize, use the bear put spread for precision strikes, swing trades, and high volatility environments where you want to offset costs. Use the long put for pure portfolio insurance or when volatility is historically low. Trading is about probability, not certainty. By capping your upside with a spread, you often increase your probability of success. Don't let greed for unlimited gains blind you to the math of cost reduction. Choose the put for crashes, choose the spread for corrections.